start off with our top segment today and get you investment strategies and wealth management advice. Joining me is Prateek Pant, co-founder and head products at Sanctum Wealth Management. Hi Prateek, thanks very much for joining in today. Let's start with your current view on the market environment. We've seen a lot of persistent volatility. What's your assessment?
Thanks Avni for having me over. Well, the market is in a very interesting stage. You know, if we look at how things started, where the overall trend of the market was quite, the broader equity markets were coming down, and there was a lot of pessimism which had actually flown into the market. From there, it seems like there has been a pause, and in a way, the markets have actually started looking much better right now. So from a domestic market environment, there are two broad factors which are really playing out. A, what is really happening within India, and second, how are some of the global factors affecting India. So if I had to just look at what is happening within India right now, the earnings seasons have started, and some of the results which have come out right now are showing a very positive trend. So the long-awaited so-called earnings revival seems to be happening at this point of time. Second, everybody is quite hopefully looking at monsoons. So you've had 2 bad years of monsoons, and this year could be a year which could actually trigger a revival back in the fortunes of some of the large consumption plays. On the international side, it's not just India which has actually rallied at this point of time, but some of the global markets across have done quite well, because the risk aversion which was there has converted into flows coming back into the emerging markets. So we are at that stage where the international flows have started coming back. The domestic earnings season is looking much better, and there is this hope of a monsoon revival. On the other side, the interest rate cycle is now showing some sort of transmission which is there. The 10-year which had actually crossed 8% level is now at below 7.5. So overall, I think the triggers are looking a lot more positive than what they've looked in some time to come.
Let's get a little more specific from a valuation perspective. Is this the right time to enter equities or wait for a further correction?
See, valuation has always been, it's a science, right? I mean, finally, when people are looking at investing, if you had to just look at the earnings which are there right now, and even maybe project as the historical earnings have been, the markets do look a little bit topped out. Having said that, we've always seen that in any type of revival rallies, the markets do tend to do much ahead of what the true valuations are. So we do expect the markets in a scenario like that could actually move away from fair valuations and could have a lot more leg in it before any type of reversal happens. So while a school of thought says that the valuations are looking a little bit on the higher side right now, but we believe that if the monsoon factors as well as some of these earning revivals, green shoots which we are seeing right now actually picks up, you could see the markets becoming a lot more expensive before they decide to turn back.
So essentially what you're saying is that we're going to see a pickup in the markets before seeing a further correction again?
So Avni, let me put it this way. I would actually be a buyer in every fall at this point of time. So if there are days when the markets actually make any type of corrections, we would actually start buying at those type of opportunities.
Right. How is investor sentiment currently? Where are you seeing interest largely at this point?
See, the investors have had a little bit of a roller coaster ride over the last couple of years. There were a lot of high expectations when the market had rallied after the new government had sworn in, and after that, the market moved the other way around. There was a lot of negative sentiment. I mean, in a way, people had taken into account that the worst could be happening, and things are not really looking up to the potential which initially people had decided. At the same time, it coincided with in a way a freezing of the real estate market, where in the past real estate had been a one-way street for them. Suddenly you found people are stranded with whatever real estate holdings they also had. So it's at the back of that sentiment that we are actually seeing some of the people again making a cautious re-entry into these markets. The last few months are really where people are looking at buying quality equity stories. People are buying again into some of the good yield assets which are there on the real estate side. So it's a mix of that really. It's a mix of buying good quality stocks. It's a mix of building yield on your portfolio on some of the real estate structures which are there, or actually also looking at investing into debt before the interest rates further fall off.
Prateek, I want to pick up on each of those points that you mentioned. Let's start with equity. Where are you seeing value right now?
Right, Avni. So we would not typically be investing in the index at this juncture, but what we would look at is which are the strong consumption plays which are playing out at this point of time. So we are seeing some good earnings numbers come from the private banking sector. We are also seeing some pretty strong performance from the auto space which is there. We continue to be fairly constructive on the IT space. So good quality large cap names in these areas is something which we would tend to build further our exposure right now. We're still staying away from public sector banking. We also would gradually be looking at this transition which would happen from the consumption space into the investment space. So there is some sort of a revival which we expect will come into the infrastructure space, but that will happen over the next 12 to 18 months. We are keeping our eyes open for opportunities which will actually emerge in that space.
You also mentioned debt. Between equity and debt, should one be overweight one over the other, especially given that we're almost at the bottom of the interest rate cycle?
Right. So debt is a tricky issue. I think it's going to be fairly tough to make money on a pure fixed income portfolio with high credit quality at these levels. You've had a sharp rally right now, and so if we had to really invest in the fixed income space, we would want to look at some of the credit opportunities which may actually come in out there and be able to give a slightly higher yield on the overall portfolio. We would be under invested on just plain duration and long dated bonds at this point of time, and would rather build a more constructive portfolio on the equity. So we are overweight equity at this juncture.
Let's pick up on real estate. What are you advising clients right now? Do you see a recovery at all in the sector?
So real estate has always been a asset class which holds a lot of emotive appeal for a lot of investors. Traditionally, investors have made money buying residential real estates when they've launched. So it's the whole primaries cycle which people have played. After certain time, they've gone and flipped those assets over. That sort of an arbitrage, unless you're ready to take development risk or you're ready to take some sort of location risk, actually seems pretty much behind us right now. What we're seeing very savvy investors look at is build a good quality portfolio of real estate assets. So they would want to buy a good warehousing asset in Hosur. They could look at investing in a good commercial office space in Pune. At the same time, they could be looking at investing in some sort of an educational or hospitality asset in some other upcoming market. So it's all building up a quality asset pool which could actually give you defined yield returns with good quality tenants. So that's really the new way in which people would pay real estate, and I think that's the trend which is there to stay here, as we see a lot more institutionalization of this market and a lot of new private equity capital actually coming into real estate.
How are you seeing H&I interest in alternative investment funds?
See, the whole alternate investment space is a very large space. So if I had to really break it up into three parts, right? So you've and it's not to do with the category 1, 2, 3 AIFs, but in general, you have either investors who are investing into pure private equity plays. You have the second category of investors who are investing into real estate through the alternate investment funds, and the third who really invest in the hedge fund or the long short type of strategies which are there. I mean, this is really where I would say 90% of the alternate investment AUM today lies. Now, we are seeing people take an active interest today on the private equity side, but mainly on mainly on the startup space. So it's not the growth private equity capital which used to be a lot more in the earlier years. At this juncture, we are seeing a lot more angel investment type funds which are garnering money. On the real estate side, again, we are seeing re-emergence of either pure debt structures, which are NCDs which have been bundled into some of the alternate investment funds, or purely equity structures. So earlier there used to be these hybrid mezzanine structures which are not happening. So it's more clients who would want clear definition of where the money is going to be handled on the real estate side. And the third asset class, the category 3 AIFs or the hedge fund strategies are now definitely picking up, because they truly in a way offer very little correlation to the broad market, and clients would want to see their investment in assets which have very little correlation with the larger markets at play. So we do see active investment coming back into the alternate space.
All right. Thanks, Prateek, so much for joining in today.
Thank you.
Time for a short break. We'll come back with a product review segment, Demystified. Stay tuned.